What is yen carry trade? What is yen carry trade? Why it is in news? Sensex and Nifty 50 witnessed a heavy sell-off on 5th August 2024 as the rout in global equities intensified amid US recession and concerns and panic in the Japanese yen carry trade. So therefore it is in the news. What is yen carry trade? The yen carry trade is financial strategy used by investors to take advantage of the low interest rates in Japan. Here is a breakdown of this works and how it works. Borrowing in yen. Investors borrow money in Japanese yen and benefiting from the country's historically low interest rates. Means taking the money at a low interest rate and somewhere utilizing somewhere else and get a more higher interest, and then making a difference this higher interest, taking the money at a lower interest and then also utilizing at other reason and at higher interest. So the difference between those money they have got, that is the profit making by the people. So investing in higher yield assets, the borrowed yen are then converted into another country. So the yen which has been taken from the Japan, they are converted into another country and invested in assets or other instructions which provide higher yields such as bonds, stocks or real estate in the countries with higher interest rates. So it is they are investing in the countries where there is a higher interest rates. So that therefore they are getting extra profit. Profit from the interest rate differentials. The key to this strategy is the difference between the low borrowing cost in Japan and the higher returns on the investment elsewhere. It has been the investment done in the different parts of the country of the world, and the investors aim to profit from this interest rate differential. Currency risk. One significant risk in the yen carry trade is the fluctuation in exchange rates. If the yen appreciates significantly against the currency in which the investments are made, the cost of repaying the yen dominated and the loan can increase potentially and offsetting the gains from the investment. If the currency of the Japan yen is getting up, then those who are investing in some other place, then their benefit will be offset. Market impact. The yen carry trade can influence global financial markets. Large scale unwinding of these trades can lead to significant movement in currency exchange rates and affect market stability. Overall, the yen carry trade is a strategy that leverages low interest rate in Japan to seek higher returns abroad. But it comes with risks, particularly related to currency fluctuation. If there is a currency fluctuation will be there, then there will be a risk. Recent yen carry trade blowback. Japan kept interest rates ultra low for decades following the implosion of an asset bubble in the 1990s that contributed to persistent deflation. Japan's central bank, the Bank of Japan, surprised markets by raising its interest rate from the near 0 to 0.25%. This unexpected move has caused the Japanese yen to strengthen significantly. The rapid strengthening of the yen has resulted in the substantial losses for those engaged in the yen carry trades. Those investors are engaged, they are lost. As the cost of borrowing in yen has increased, the profitability of these trades has diminished. Their impact on the global market. The Nikkei 225 index, Japan's primary stock market benchmark, and plummeted by over 12% in a single day. You can think of how much difference 12% in a single day. The marketing its worst decline since 1987 Black Monday crash. The reverse carry trade was a major cause of concern for the US too, as the S&P 500 declined by 1.8%. So it means that the United States Stock Exchange S&P 500 also has been affected. South Korea's KOSPI has been affected. Taiwan's weighted index experienced significant declines, with both indices falling by more than 8%. Impact on India's market. Despite the global market volatility, the Indian markets have remained resilient, as the Sensex closed 2.74% down, while the Nifty 50 crashed 2.68%. The Indian markets are now more balanced than before, as the markets have also gone through the recent major events such as elections and Indian Budget 2024. Way ahead for investors shift to high quality stocks. The investors should focus on companies with strong fundamentals and substantial growth, moving away from low growth, low quality segments. Then the investor can save themselves. Orientation towards large caps. Prioritize large cap stocks for their stability and resilience, especially during market volatility. Selective exposure to mid caps and small caps. While a large cap should be dominate your portfolio, and also consider quality mid caps and small caps with strong fundamental and growth prospects. Then the investor can be benefited. Monitor global events. Be aware of the global factors like yen carry trade, unwinding, US recession fears, and Middle East conflicts that may cause market volatility.